All right, folks, today is Monday. Depending on consensus in the class, this may be the only day that we meet this week. So for those of you who were not here on Friday, we decided as a class that we were not going to meet on Monday. However, I do not want to be one of those people that does not represent everyone, okay? So for those of you who are not here on Friday, if you strongly oppose this plan of us not meeting on Wednesday, of us taking off class, because again, you all are paying for my time and I'm willing to provide my knowledge and my resources to you. We can have a class on Wednesday if you really, really want one. So I don't want this coming back in my evaluations haunting me. It says he's always canceling class and didn't give me about. I'm allowing you to have a voice, okay? So those of you who are absent on Friday, you can raise your hand right now, and I'm sure everybody in the class will be completely understanding that you want to have class, and we will have a class on Wednesday, okay? Is there anybody who was not here on Friday that wishes to have class on Wednesday? Going once? Going twice? All right. Well, seeing as there are no objections to us canceling class on Wednesday, that we will have class on Wednesday. Now, again, I want to make sure that this was a unanimous consent item, okay? And this is not something that you can use to blackmail me at some point in the future, all right? And if you do, I will find out who it was, because I already have my suspicions of the most likely people in the class who would do something like that. All right. Not going to mention any names, but they might share my initials. So yeah, I'm not going to mention any names. My initials are MB. She's completely oblivious to what I just said. Oh man. This is one of those weeks, I guess. All right. Since we have decided upon the fact that we are not meeting on Wednesday, I do want to remind you that we do need to organize groups and topics. I've heard from a few people in the class, but the majority of people have not reached out to me. Again, if I don't have any group or topic assignments, then I will do those random. Topics are not as pressing, but I would like to make sure the groups are finalized. And like I said, the mega group of 6 will not happen, but you're more than welcome to select 2 groups of 3 and I will sign you out, okay? But or a 1 group of 5 and then out one of you, which either one of those are personally are fine options. All right. I do want to talk really quickly about upcoming schedule, because there's some important things you want to be aware of, and I've not done as good a job in the past of making sure people are aware of these things. The problem with Brightspace is I can't really change the notifications. I would probably set like multiple notifications for these. So here I'm going to do it in class. So here we are, chapter 17. We are not meeting on Wednesday, so we can just say goodbye to that. Let's say, nope, nothing. There's nothing there. Midterm break is this coming Thursday and Friday. We come back, we're going to wrap up chapter 18 and chapter 21, and then we're going to do the homework for that section, those 3 chapters. That will be the final homework that we have before the next exam. Our next exam is going to be basically 2 weeks from this coming Wednesday, which seems like it shouldn't be that soon, but you know, time waits for no one, I guess. So please keep in mind that we do have an exam coming up. It's going to cover all the content since we've covered since the previous exam. So that's chapter 6, 7, 8, 9, and then chapter 17, 18, and 21. And this is kind of disparate content. It's a little bit of a weird exam because the stuff doesn't necessarily relate to one another, but we'll get into the business processes after the end. Something I wanted to mention, because it does come up and people tend to forget it, is the Excel assignment is due at the end of week 12. I know that's 4 weeks away, or actually closer to 5 weeks away, but it does creep up on you. This is the one assignment that most often, frequently, people just kind of they drop the ball on because they run out of time to do it. Do not wait to do this assignment till the last minute. It is not a difficult assignment, but if you wait till like the week of, you may find yourself running out of time. It does take some effort and some time. And again, it would be very unfortunate if you have to sit for the final exam simply because you failed to complete this assignment in a timely manner. Again, I suspect everybody in this room has the skills necessary to complete the assignment. This is just a warning. This in my history has been the one that people have just really struggled with just because they don't put it in their schedule. And then I did want to mention something that might happen. Okay, so this is tentative, but we do have the possibility of an advisory board coming to present to our class. That would be on the 13th of November because they are coming for the 14th, and they'll be here. They would be here for this class. Be a great opportunity to network with people in the field and just to have an opportunity to reach out and ask questions. If that happens, I will let you know, but it will change our schedule somewhat because obviously we can't have chapter 13, 14, 15, 16 discussion if we do that. So probably what will happen is I would change this to chapters 12 and 13 we would cover on the 4th. We would have homework due on the 6th. Okay, Excel assignments will still be due on the 8th, but homework would be due on the 6th. We would start chapters 14, 15, and 16 here on the 8th, and then we would finish on the 11th. The homework would still be due on the 15th, but we'd have a session there where we do the presentation. I'll probably also, if we do have a presenter, I will probably also have you all prepare questions in advance to prepare for the presenters. This is just something that I've expected, even though you all are very vocal when class goes on. When people are up here talking, you tend to stop asking questions. All for Hudson. Hudson asks a lot of questions, so kudos to you, Hudson. But yeah, but everybody else is just kind of quiet, says, I have plenty of questions, but I don't want to lift my voice up, at least not between the time of 1:30 and 2:20. I am dead silent between that time. So I'm going to encourage you all to have questions. And if necessary, I'll nudge you and prompt you to ask those questions for the presenters. All right, that kind of takes care of all our busy work. Let's go ahead and talk about chapter 17. So this is the end of the book, and you may say this is a little bit weird that we're doing the end stuff before we do the business process detail. This is actually a traditional approach that people have taken for teaching auditing. We're going to be getting to very specific requirements, specific procedures when we get to the business process areas. But I like putting those all together. And in past, before I changed this, the format of the class used to be chapters went in order. And in the past, when I did that, I felt like these chapters were an afterthought. So I really wanted to spend some time talking about this chapter, chapter 18 and chapter 21. We will have kind of a pretty heavy sprint when we get to chapters 10 through 16, because we're going to cover all those in 3 weeks. That being said, I do think that we have covered all of the information by then that we will need to know. This is not going to seem foreign to you. We're not going to cover anything that we haven't already covered other than unique content to this particular item, our area. So this is basically completing the audit engagement. And what that implies is we have finished test of controls. We have finished our substantive tests, both substantive analytical procedures and substantive test details. We are ready to conclude the audit. But before we issue the opinion, we've got some specific tasks that we have to perform. And so this chapter is going to be covering those specific tasks. So one of the things that we need to talk about is we need to talk about a lot of consideration about whether the client has done what they're supposed to be doing according to generally accepted accounting principles. And this should be things that you're somewhat familiar with because you've covered these in previous courses. One of these I specifically know you covered because the next slide is actually a clip from your Intermediate Accounting 2 textbook, okay? So remember contingent liabilities, those good things that you had to cover back in Intermediate 2? So contingent liabilities, existing condition or set of circumstances involving uncertainty about a possible loss that ultimately result whether some future event occurs or fails to occur. Yeah, so basically, when we talk about contingent liabilities, we're talking about something that's may occur in the future, and we're not certain about how it should be treated in the financial statements. Now, just for reference, this is something you should already know. And if you ask, is this come on the exam? I don't tend to ask questions specifically about this, but that being said, you should know this already. So the criteria for incurring a contingent liability are that the contingent liability is probable and at least reasonably estimable. Which makes sense because if it's something like a lawsuit, that's the prime example of a contingent liability. If you have a lawsuit that you're trying to determine how much should you recognize for it, it's probably you're going to lose the lawsuit and you know exactly what your settlement would be. That's the amount that you should record as a liability. Now, if it's not probable, if it's less than probable, okay, if it's only reasonably possible, then it's just going to be disclosure only. And if it's not reasonably estimable, also disclosure only. Now, the reasonably estimable makes perfect sense. If you don't know what the amount is, you can't record an amount for it, okay? As far as the probability, that is the threshold requirement. It has to be at least probable, which is certainly subjective as to what that means, but that's kind of the assessment. The remote, there's no disclosure required. We don't have to put anything in there. So this is, again, stuff that you should remember from 303 that we need to talk about. So why did I bring this up here? Why am I reviewing this here? Well, first of all, we as auditors have a responsibility to make sure that all contingent liabilities have been accrued or disclosed as necessary. How do we do that? How do we go about doing that? Well, here are some procedures that we're going to perform. we're going to do two kind of basic overarching procedures that we talked about. We're going to inspect records and documents, and we're going to perform confirmations. Now, when we talk about inspection of records and documents, we want to inspect documents related to corporate governance and shareholders groups, so like the board of directors and the audit committee. We'll look at sales, purchase contracts, loan agreements, and leases, see if there's anything outstanding that might be of note, tax returns, and guarantee arrangements. So these are all items that might lead to consideration of contingent liabilities. We also can send out third-party requests to organizations where we might have problems, where we might have issues that come up. So we talk about confirmations. We would be talking about sending to financial institutions, so banks and intermediaries, and then lending agencies. These are all possible organizations that would be involved in contingent liability generation. So audit process for this. This is basically understanding this, the possibility of, so just for clarification, this is understanding the possibility of contingent liability. Now, evaluating the necessity for how we record the contingent liability, whether it's accrual or disclosure. Some of the steps we're going to take is we're going to talk to management. We're going to say, what is your process for evaluating and recording contingent liabilities? We want to evaluate any information that comes from the attorneys about pending or threatening lawsuits, because we know that a big area of contingent liabilities are going to be these existing lawsuits. We're going to obtain a legal letter that describes and evaluates all pending litigation claims and assessment, which I'm going to talk about here in just a second. And then we want to get a written representation from management that all litigations, claims, and assessments have been disclosed. Basically, this last step is kind of a CYA, where we just basically try to cover anything that might be outstanding and say, we talked to management, asserted to us that there were no outstanding contingent liabilities that they have their knowledge. Now, is this enough to protect an auditor who fails to identify a significant contingent liability? Probably not. They did not do their due diligence, but at least we're showing that we're trying to perform some sort of act in that regard. Now, we're going to have to do something that I personally find very distasteful. We're going to have to rely on lawyers, okay? We have to rely on lawyers, okay? So we got to rely on this guy and this guy right here. And you don't know who this guy is, but this is the old curmudgeon named Dallin Davis that I always talk about and make fun of. It's a shame that you never got to know him. It's both a blessing and a curse, I guess I should say. It's a blessing that you didn't get to know him, because he was kind of a grumpy old man. No, not kind of. He is a grumpy old man. Okay, but it's a curse in the fact that none of my stories have any context, because you don't know who this man is. All right. But he was a lawyer, tax attorney. He actually taught tax before Dr. Deers was here. Anyway, they're all lawyers, and we have to rely on these guys for information, which, the only thing I would rely on is like throwing darts to try to hit these guys. That's what I would be doing, okay? But yeah, I don't want to rely on a lawyer, but we have to. That's a part of our job as auditors. So we're going to send them a letter of audit inquiry, which we're going to call, the vernacular for that is a legal letter. It's going to send it to the attorneys as a primary means of obtaining or corroborating information about the litigation's claims or assessments. That's the book definition anyway. I want to alter this definition ever so slightly, okay? I want to alter this definition ever so slightly. I want to remove that word obtaining, all right? And part of the reason for that is that this is not an effective method for obtaining information that you don't already have knowledge about. Now, think about this logically. Who does the lawyer represent? Do they represent you, or do they represent their client? That was not a trick question. It was a very easy question. It's supposed to be an easy one. They represent their client, okay? They represent their client. So they're going to do what's in the client's interest and not what's in the auditor's interest, all right? So if the client has not disclosed information to you, the lawyer has no obligation to do so either. And we're going to come up and say to the lawyer, hey, the client hasn't told me all their contingent liabilities. Can you give me a list of all the contingent liabilities? Says, I don't know of any contingent liabilities. Sorry, man. Yeah, that's what they're going to do. So we want to make sure that we corroborate information that we currently have. It's unlikely the lawyer is going to share any information voluntarily with us. So that's just kind of a point of contention. We see that word obtaining. Technically speaking, that is with the purpose of a legal letter, but it's not a good method for acquiring information that we don't already have detail about. All right. Next, we're going to talk about commitments. Companies can enter commitments to purchase materials or sell products at a fixed price. The goal in doing so is to obtain predictable pricing or secure the availability of materials. And accounting standards require commitments to be disclosed in the financial statements with adjustments to OCI for any gains or losses. So I'm not going to go too much into detail about the accounting for this, and there's definitely no way I'm going to ask you how to do the counting for these, okay? This is something that only people like Dr. Eisen understand, because Dr. Eisen's weird, man, okay? Dr. Ison's weird. He understands the derivative accounting and kind of the hedging instruments. But yeah, that's something I kind of looked at and I said, nope, I'm done. I'm moving to auditing because I don't want to get into deep financial accounting turmoil. But we do need to understand the basic accounting treatment here. So one of the things to note is that they said that this has to be disclosed in the financial statements, which sure sounds a lot like a contingent liability, information that needs to be disclosed to stakeholders for that purpose. Specifically, if there are gains or losses in these instruments, then they have to be adjustments to OCI, their comprehensive income. So what are we going to do? Well, we're going to talk to the revenue and purchasing personnel, say, are there any commitments that we need to be aware of? And we're going to review the minutes of board of directors meetings, which sounds a lot like what we did for contingent liabilities. In fact, the procedures the related commitments are very similar to those for contingent liabilities. I would argue that if you have similar personnel that are doing responsibilities in different areas, that you can actually kind of kill two birds with one stone and perform the same procedures simultaneously. The auditor's main concern relating to commitments is to ensure that appropriate disclosures are provided in the financial statements, which was kind of our goal for contingent liabilities, although contingent liabilities have the possibility of also being accrued as journal entries or recorded as transactions in some scenarios. So a little bit less intuitive. All right. I need to check something real quick. I'm going to be very disappointed with myself. So hold on. I forgot to open up. Okay, I've got it. All right, good. All right. So our next thing is one of my favorite things to talk about. We're going to be talking about subsequent events. All right. You guys remember subsequent events from your financial classes? Okay. This is an event that occurs after the balance sheet date, but before the issuance of financial statements, and has a material effect on the financial statements. Now, the note is that subsequent events generally require recognition or disclosure in the financial statements. The management is required to disclose the date through which the entities have considered subsequent events, and auditors are responsible for evaluating the handling of the subsequent events in the financial statements. So you already knew about the first part because you talked about subsequent events in your financial class. But we as auditors have to make sure that subsequent events are appropriately disclosed and treated in the financial statements. So in order to do that, we probably should review what the appropriate treatment for subsequent events are. Now, does everybody feel comfortable that they remember everything they should know about subsequent events from their financial accounting classes? Just nod your heads and say yes, or we'll, no, I'm not going to do that. Okay, we're going to actually talk about this. It's actually not that difficult, but we do have to do a little bit of a distinction. So for type 1 event is conditions existed before the balance sheet date and affect estimates that are part of financial statements. All right. Prime example of a type 1 event is going to be a lawsuit. Okay, a pending lawsuit, one of those contingent liabilities we were talking about. If a lawsuit gets resolved before the issuance of the financial statements, that's considered to be a type 1 subsequent event because the condition did exist before the balance sheet date and it was settled after the balance sheet date. Treatment for this is very simple. If it's a type 1 event, we adjust the financial statements. Management has to adjust the financial statements. We as auditors have to make sure that management does a proper adjustment to the financial statements. So think about this intuitively, where they've got an accrual for a liability in the financial statements because they think that it's probable they're going to lose a lawsuit. Then the lawsuit gets settled and it's for amount much less than what the lawsuit is. We probably don't need to incentivize management. We're going to tell them, hey, you know what the amount of the lawsuit's going to be. Record that instead of your accrual. Record that actual amount, the actual amount of the lawsuit settlement. That's basically what we would say for the adjustment. Now, type 2 events are a little bit more tricky. These are conditions that did not exist at the balance sheet date and do not affect the accuracy of the financial statements. If that's the case, why do we disclose them? It's because they're significant enough to affect user judgment. So stakeholders might want to know about how these things are going to affect future operations of the organization. Really good example of this is going to be a natural disaster. If a natural disaster occurs, then that's probably going to be enough to impact stakeholder interpretation. So at a very base minimum, this requires disclosure in the financial statements. If it's a subsequent event, type 2 subsequent event, at the very base minimum, we have to have a disclosure in the financials. There's a possibility, depending on the severity of the subsequent event, that we'd actually have to issue, or the client would have to issue pro forma financial statements. Have you all heard that term before, pro forma financial statements? Basically, these are forward-looking financial statements that assume a certain scenario. So but instead of assuming that everything is going to be going on as planned, financial statements, the operations organization are going to be impacted substantially by this change, and we want to know what the effect will be. Really good example of this. There was this big thing that occurred 4 years ago that we've talked about. It's a couple times in this class. Massive worldwide effect, worldwide impact, this pandemic that occurred right around the month of March 2020. Does everybody remember that? You all probably in middle school or high school at the time, maybe just beginning college. But yeah, that was COVID. And a lot of organizations actually had to disclose COVID as a subsequent event because of the way that its timing worked, that it completely impacted their operations, and they had to issue a disclosure, and several of them tried to issue pro forma financial statements, try to predict the impact of what was going to happen with COVID. All right, so yeah, that was kind of fun. So everybody feel good about this? Feel like you could actually identify? I don't believe you. Those of you nodding your head, I don't believe you. Okay, so I'm going to test you on this. Okay. Called you out like that. Wow, how dare you. So we're going to play a game. It's going to be called type 1 or type 2. So you're going to tell me, is it type 1 subsequent event or a type 2 subsequent event? Okay. Loss of the entity's manufacturing facility or assets resulting from a casualty such as a fire or flood that occurred after the balance sheet date but prior to the issuance of the financial statements. So this definitely is a subsequent event. What type is it? Type 2. This is a natural disaster. A perfect example of a type 2 event. All right. Capital stock or bond issuance by the entity after the balance sheet date but prior to the issuance of the financial statements. Assuming this is a subsequent event, which we are going to assume that, is a type 1 or type 2. Less certain about this one. So it doesn't mention anything about pre-existing conditions as of the balance sheet date. So it seems like this was probably something that occurred after the balance sheet date without any previous effect, meaning that it would be type 2 event. Okay. Settlement of a lawsuit after the balance sheet date but prior to the issuance of financial statements for an amount different from the amount recorded in the financial statements, a year in financial statements as a contingent liability. This should be pretty easy. Which one's this? Yeah, this is type 1. This is the example of type 1 we talked about. But they're not all going to be so easy moving forward. Loss on receivables caused by conditions such as a business failure arising subsequent to the balance sheet date. I got it. Type 1. Does everybody agree with that? Agree with that? Shouldn't agree with that. It's a type 2. It's a type 2. Why? Because the conditions did not exist at the balance sheet date. We didn't know that there was going to be a loss in receivables. Now, if we change the situation slightly, if we were to say loss in receivables that we had knowledge about before the balance sheet date, then it would probably be a type 1 event, but that's not what the condition says here. All right. Uncollectible account receivable resulting from deterioration of customer's financial condition prior to year end, about which the holder of the receivable is unaware. The customer declares bankruptcy after the balance sheet date, but prior to the issuance of the financial statements. Okay, so did the condition exist out of the balance sheet date? It did. Okay, so this is an example of type 1. Okay, so it's a little bit different from the one we just talked about. Okay, because the conditions did exist previous to the balance sheet date. Purchase or disposal of business by the entity after the balance sheet date, but prior to the issuance of the financial statements. Type 2. You can hold up one finger or two fingers. Make sure if you hold up one finger, it's the correct finger. That's right. Type 2. Okay. Yeah, type 2. Sorry, it's auditing, guys. I gotta try to make it the thrilling where I can, Should do more of that. They're like the quiz show. Type 1 or type 2. Yeah. We'll come up more subsequent events. All right. So there's a couple more issues we need to talk about. Now, this issue is not likely to come up in a public company audit, but it may come up in a private company audit. So there's a subsequent events period that's going to exist from the financial statement date to the issuance of the financial statements. All right. But there's a possibility we could finish the audit before the issuance of the financial statements. So what if we issue the report on the 15th of February and they don't issue the financial statements until March 5th? We've got a period of time here where we're no longer auditing, but there could be a subsequent event that could occur here. Now, if it occurs here, it's fine because we're still responsible for auditing everything during this period. But what happens if we issue our audit report, then a subsequent event happens here? We have no liability, right? We're just off of it. We're just like, we're gone. We're auditors. We're on the beach in Hawaii. We're sipping our mojitos. We don't care. You could go for a mojito right now. I probably shouldn't say that on camera. All right. All right. So we have what's called a dual dating issue, which I'm a big fan of the term dual dating because I grew up in the I remember the 90s. I watched television and they had these shows like Blind Date, which were these weird dating reality shows. I think dual dating would actually be a really good term for like one of those shows. Yeah, and those shows were so bad, by the way. Ignore that I said that. Okay. So what does this mean? So when a subsequent event after the audit has been completed, the auditor considers the following options to date the audit report. So we've got two options. All right. So we can actually dual date the report, which is basically saying that we're going to use the original date of the audit report. So February 15th, And then we're going to add a second date, which is the date of the subsequent event. So this actually limits our liability to just that single event referenced. So just for context, something occurs, we'll say on March 1st here. March 1st, we say the audit report date is still February 15th, but we're going to add one more date for the specific event that's referenced right here, because we're going to audit and make sure that that subsequent event was properly treated in the financial statements. All right. That's dual dating. That limits our liability to that single event. The other option is if it's a small issue and we believe it's properly achieved, we can extend liability. We can change the entire date of the report. We can say we'll change the date to March 1st, which extends our liability to everything that occurred as of March 1st, not just that single event. All right. Now, the reason I say that this doesn't likely come up in PCAOB audits and public company audits is the recent practice has been is that auditors have issued their audit report on the same day of the financial statement issuance. So that being the case, the audit report date would naturally be the same date as the last date for considering subsequent events. But this might come up in private company audits. Yes.
Why would you ever want to extend your audit?
If it's just a minor issue where you don't think anything's coming up and you just want to have a single date, that's the kind of this consideration. If it's something that it's unlikely to have a material effect, any other issues that might come up. But it's an excellent question because practically speaking, it doesn't seem like it'd be a great idea. All right. So what are we going to do for subsequent events? We're going to talk to management. We're going to read the interim financial statements. So this could be monthly or quarterly. We can read the meetings minutes, inquire the legal counsel, and examine the book of an original entry. So looking at the general ledger and seeing if there's anything in there that kind of raises our attention. Then auditors of public company are also responsible for reporting on any changes in internal controls that can affect financial reporting. That sounds very familiar because we did talk about this back in chapter 7. And the end of the reporting period and the date of the auditor's report. So this is basically saying, not only are we concerned about subsequent events or actual events are happening, but subsequent events relating to internal controls. What if we had a continuous control that was operating effectively as of year end, and then all of a sudden that control just got massively disrupted? Like the control itself stopped functioning properly, or whoever was responsible for maintaining that controls decides they want to commit fraud, and they were caught committing fraud there. What does that mean for the audit? The answer is we have to ensure that the controls are working properly through the issuance of the financial statements. So we do have responsibility for subsequent events relating to internal controls, at least as they relate to financial reporting. So some ways that we can actually check that is we're going to look at internal audit reports. We can look at regulatory agency reports on ICOFR. This will frequently be the PCAOB if they're doing testing in this area. Independent audit report of reportable conditions. I'm not sure why the screen's blocking that out. Hold on a second. Oh, this is just awkward. Okay. I wanted to be able to show you all the entire screen. There we go. Okay. Oh, and never mind. This bar is right in the way. This word down here is conditions. Okay. All right. Independent audit reports are reportable conditions. And then information obtained from the audit of internal controls or financial reporting. So remember, this is a separate audit. The internal controls or financial reporting is part of the integrated audit, but it's a separate, I shouldn't say separate audit, but it's a separate report issued. But the reason that we perform that integrated audit is because we want to make sure that information that's relevant to both financial reporting and internal controls, we have information that can be used in both areas. So we can use information from this audit of ICOFR to actually answer questions about subsequent events and internal controls. All right, so now we're on to the final steps. So we talked about 3 really important areas. We talked about the contingent liabilities. We talked about the commitments, and then we also talked about subsequent events. So what are we going to do after that? Well, we're going to perform these things called final analytical procedures. You guys remember talking about that? So we did talk about 3 types of analytical procedures: preliminary, substantive, final analytical procedures. By the way, which one of those are required? Some of those are required by auditing standards. Does anybody remember which ones? Preliminary and final analytical procedures. Substantive analytical procedures are a good idea, but they're not required. This one's a required step according to auditing standards. What are we trying to do? We're trying to determine if the final numbers, all adjusted numbers according to the audit, are intuitively sensible, if they make sense. If not, we're going to say, why does this number stand out so much? So just doing a final analytical procedure in that area. We're going to obtain a management representation letter. An example of which is on page 570, 571. Management representation letter is really, really weird, okay? Why do I say that? Because it's a letter that is addressed from management to the auditor. Okay? So everybody pick that up. It's addressed from management to the auditor. So given that context, who do you think writes the management representation letter? Well, think about it this way. If you address a letter from you to somebody else, are you usually the author of that letter? Yeah, it doesn't work that way in auditing, unfortunately, okay? Management representation letters drafted by the auditor, and they basically sign it as based on the, or have management as the person who's creating the letter and is being addressed to the auditee, which is weird, okay? Like I said, it's really weird. It's basically saying, okay, we're gonna write the letter for you, then you're just gonna sign it. And the idea being is that this letter says, here are all the representations you made and all the information that was given to us over the course of the audit, which of course management's not going to track every single detail of that. The auditors are going to, but management still has to sign this letter saying, we gave this information to you. We made these representations to you. So really, really weird management representation letter addressed from management to auditor, written by the auditor. It makes no sense. We're going to review the working papers. Okay. This is usually performed by the engagement partner, the audit engagement partner. All right. What are they looking for? They're looking for sufficiency of audit evidence. What does sufficiency mean, by the way? We talked about this much earlier in the semester. You're not allowed to forget all this stuff, by the way. Sufficiency, it's either quality or quantity. What do you guys think? Quantity. We have a winner. Quantity is the correct answer, okay? We also want to make sure that we understand the effects of detected material misstatements. That's our detected misstatements. In other words, we're trying to determine if these misstatements represent a material effect on the financial statements. If the answer is yes, then there's probably going to be an adjustment necessary, but the partner will make that assessment. So this is a preliminary review. This is the person who's in charge of the engagement. The audit engagement partner will perform the preliminary review. Why do I mention that? Because something else is going to come up in just a second that's relevant. We're going to perform a final evaluation of the audit results. This is where we determine what the opinion is based on all of the results of the test work performed and the response from the client. Just because there's a material misstatement doesn't mean that we immediately issue a qualified opinion or adverse opinion. Remember, we do give the client an opportunity to correct the problems. If they do so, we can still issue a clean opinion. If they fail to do so, then that's where we're going to say there's a problem, we're moving on. So we're going to perform their final evaluation of saying, here's the issue, a report we're going to issue based on the actions of management and based on the results of the audit. Then we need to evaluate financial statement presentation and disclosure. This is one of those areas that we've talked about, kind of a lingering concept in this particular chapter, but we want to make sure that the financial statements are in compliance with generally accepted accounting principles, GAAP. Okay, so even though I said I tried to duck out of learning about financial accounting by becoming an auditor, you do still have some responsibility for knowing financial accounting. You do need to know generally accepted accounting principles. By the way, this assumes that the framework that you're operating from is generally accepted accounting principles. Is it possible to perform an audit on a different framework? We're going to talk about that more a little bit when we get back from break, but the answer is yes. Okay. Not for a publicly traded company. Publicly traded companies are required to operate according to generally accepted accounting principles. You may inquire about foreign companies. They operate according to international financial reporting standards, which are certainly acceptable under PCAOB guidelines. But for the most part, we're going to be talking about domestic companies, and those domestic companies will be required to report under US GAAP. Okay. But if you're talking about a private company, they may have a bunch of different frameworks, which we'll get into more detail of those. This is generally assuming GAAP, but it's going to be whatever the reporting framework is for that particular company. All right, obtain an independent review of the engagement. All right, remember I said the review up here, who was the person that did this? Or who was the individual? The engagement partner, okay? This is going to be a non-engagement partner, Somebody who is not associated with the engagement also performs a review of it, just kind of to make sure that there's an unbiased evaluation. Here's an interesting question though. What if you're a small firm? What if you're a firm here in Kirksville that has exactly one partner in the firm? What is the solution then? So the same person performs both reviews? Seems kind of redundant. The answer is that you can also have another firm perform this review as well. The only scenario that will really come up is if you're a small firm that you need to hire somebody else because you can't perform an independent review given your staffing. And then we're going to evaluate the client's ability to continue as a going concern. That's a really important concept. This term going concern, if you've ever heard it before, one of the most important things in financial accounting and in auditing that we're going to be talking about. We're going to get into a lot more detail on that. We're going to talk about it a lot today, and then we're going to talk about it a lot when we get to discussion next week on issuance of reports. What does that mean? We'll get to that in just a second. That's one of the final things we're going to be talking about. But let's talk very quickly about archiving and retention. So this is going to be the criteria for public company audits. I'm only going to require you to know the criteria for public company audits right now. For those of you who are going on to grad school and going to be in the audit track and sit in seminar on auditing, we'll talk about archiving and retention requirements for private companies as well. They are slightly different. But basically, the requirement is that once you complete the audit, you have 45 days to get your stuff organized, okay? Get it set up so that you can actually put it into storage and have it for retention. Once that's done, you have to retain all audit documentation for at least 7 years from the completion of the audit. Now, this is usually going to be the audit report date, okay? The audit report dates that they have to, that they determine that 45-day period. So once the audit report date audit report's issued, you have 45 days to get everything archived and prepared for retention. And that 7 years is basically the minimum time. Sometimes a longer period of time is required by law. For example, I do not think the Enron working papers will ever be eliminated. I think they will be archived forever as a standing lesson of what not to do when it comes to auditing. So, as far as what you have to retain, you need to retain all documents that form the basis for the audit review, but it's also important to note, you need to include any information that's inconsistent with the issued opinion. So if you issued an unqualified opinion, but there was results in your testing that seemed to indicate that it should not have been an unqualified opinion, your audit documentation has to point that out. That way, if your reviewer comes in, particularly a government regulator comes in and says, well, you issued an unqualified opinion, but there appears to be a material misstatement right here, you have to explain that, okay? You have to be able to explain why you felt that it was okay to issue an opinion that was not, or issued an opinion that was not consistent with the work that you performed. In all likelihood, you probably do not want to issue opinions that are inconsistent with that work. All work should be considered, but if there's anything that's inconsistent with that, it does need to be noted in the documentation. All right, let's talk about going concern. So accounting standards update 2014-15 disclosures of uncertainty about an entity's ability to continue as a going concern requires that management assess the entity's ability to continue as a going concern. Well, that's just a repetition, but what does that mean? Okay. If I say that I'm going to continue as a going concern, is that a good thing or a bad thing? That's a good thing, okay? I would like to continue as a going concern for a very long time, okay? That means that I'm not planning on leaving this earth anytime soon, okay? I'm not planning on leaving this earth. And if we can say going concern as it relates to my job, hopefully I'm a going concern. I'll be here for a long period of time. So a going concern is basically an evaluation of whether or not something will retain its existence, will remain in existence. When management is assessing going concern, they're trying to say, will this company exist for the foreseeable future? All right. So from an accounting perspective, financial accounting perspective, management has to actually include, they have to actually assess their entity's ability to continue as a going concern, their existence for the foreseeable future. Under PCAOB Auditing Standard 2415, the external auditor has to evaluate this assessment. They have to evaluate whether there is substantial doubt about a client's ability to continue as a going concern for a reasonable period of time. Now, for our purposes in this course, we're going to say 1 year. What is the likelihood that 1 year from now, this company will still be in business? Okay. What is the likelihood that 1 year from now, I will still be teaching? The answer is it really depends on how much I frustrate Dr. Caden, okay? If that amount is varied year to year. I've not reached my threshold just yet, so I'm still planning on being here next year. I'm going to be a going concern, all right? A going concern. So talking about auditor evaluating the going concern, what does the auditor have to do? Well, the very first thing is they need to actually determine if audit procedures indicate that substantial doubt about the entity's ability to continue on going as a going concern exist. So we do the audit, we look and say, all right, their numbers are bad. Their collections have basically we're at 90% and they've gone down to 50%. They're not generating any cash. They're going to be operating at a loss this year. There's some problems here at this organization. They seem to have a dysfunctional environment that doesn't have anything together. So they say, I believe there is substantial doubt about the entity's ability to continue as a going concern. That's the first question. So if the substantial doubt exists, we move on to question number 2. We're going to determine management's plans to address the issue. We're going to talk to management and say, here's the deal. we don't think you're going to be in business a year from now. And management's going to say one of two things. They're going to say, whoa, that's news to me. I thought we were doing great. Okay, well, you had $1 billion loss this year. Okay. That's probably not good. All right. We're concerned that you may not have what it takes to continue on in business. So management's either going to stay, all right, you know what? We disagree with you. We think that everything's fine. Okay. Or they may say, well, this is a really cause for concern. We are going to do everything that's necessary to meet this problem, to address this problem, or someplace in between there, but they're going to do something. At that point, we're going to ask another question and say, are management's plans sufficient? If we believe management has done an appropriate job of addressing this going concern issue, then we can stop there. But what if we look at management's plans and we say, we still think the substantial doubt exists, okay? So whether substantial doubt exists. If so, then we've got some requirements that we have to meet as auditors. First of all, we've got to make sure that they disclose this information in the financial statements. As part of that assessment, the client is required to disclose whether or not the substantial doubt about their ability to continue as a going concern exists. Okay, so they need to actually disclose in the financial statements based on operations, based on the results of operations over the past year and previous years. We believe that there may be concern about our operations moving forward to the near future. Okay, they actually have to disclose that in the financial statements. This has to be a disclosure included. They have to say, we may not be in business a year from now. That's one requirement. Then we as auditors also have to say that. We as auditors also have to issue that, saying that explanatory paragraph is going to be issued in the audit report. All right, so there are a few things that I want to make sure that we're clear on, and I will repeat these. The reason I'm going to repeat these multiple times is because we have a week break before we're going to talk about this again. The first thing is that the existence of a going concern does not necessarily affect audit opinion. Okay, now think about why. A going concern says the company is doing badly. They're doing badly. The results of their operations are just showing that they're not going to exist. That does not mean that they've done a bad job reporting. They could report all of their information correctly, just their information is bad. So we can have an unqualified opinion with a going concern. All right, that's a possibility. That being said, how could a going concern affect an opinion? That would be if management fails to disclose their troubles. If we as auditors say, yeah, you have substantial doubt about the ability to continue as a going concern, you're not going to be in business a year from now if you don't change your ways. And they say, if we record this or if we disclose this in the financial statements, it will wreck our stock price. And we don't want that to happen because our CEO has got like 10% of the shares, okay? And he would just be very unhappy, all right? If they fail to disclose this information, that is when we actually are going to issue something other than an unqualified opinion, because that is a required disclosure under GAAP that they have to meet. And if they fail to do that, there's a departure from GAAP, and that's either going to be a qualified opinion or an adverse opinion, depending on the severity of that disclosure. Probably an adverse opinion because we're talking about the end of the company as we know it. So we're going to talk about this again, but those are two really important considerations to make. All right, to wrap up, auditing standards require the auditor to communicate the following matters to the board of directors and the audit committee. So the responsibilities in terms of the engagement, that's pretty straightforward. Information provided by the audit committee that is relevant to the audit. So kind of saying information that the audit committee provided in addition to that provided by management. The overall audit overview of the overall audit timing and strategy. Observations of the audit that are significant to the financial reporting process. So these are going to be kind of suggestions related to the audit itself. All significant deficiencies and material weaknesses identified both during the audit. We talked about that during Chapter 7. Significant deficiencies and material weaknesses all need to be disclosed to the audit committee. And then a management letter, not to be confused with the management representation letter, with any recommendations for the client, okay? So the management representation letter, that was written as addressed from management to the auditor. A management letter is written addressed from the auditor to management, and it basically says, you know what, we just finished our audit. We looked at internal controls. We looked at your financial statements. Here's some suggestions we would have for the future that might improve your operations. That is a management letter. It's a recommendation letter for the client. All right, last thing we want to talk about. An auditor determines that previously issued financial statements are in error and the audit report is affected. He or she should request that the client issue an immediate revision of the financial statements. So what does that mean? It means you finish the audit and then you're done with busy season. And what are you going to do? Because that's what all auditors do at the end of busy season. They leave the contiguous United States and go to Hawaii, okay? So you're sitting on the beach in Hawaii trying to relax. You're sipping your mojito. Again, shouldn't say that I want a mojito, but I do. All right. But it's because mojitos are delicious. Let's be honest. Okay. All right. So you're enjoying your mojito and you get a call from the client, and the client says, "Hey, you know those financial statements that you should unqualified opinion on?" It says, yeah, I do. I feel pretty proud about that. I put a lot of hard work and I'm relaxing and enjoying it now. Could you please leave me alone? It says, no, there's something you should know. Basically, there's an entire warehouse of inventory that was not included on the financial statements that you guys did not observe. Do you think that's going to affect the audit opinion? And you'd be like, yes, that's severely going to affect our opinion. It's because we haven't done testing on that. Okay. So is this a doomsday scenario? Do you immediately have to issue an adverse opinion if this happens? The answer is no. Basically, what you have to do is you have to get on a plane, you have to fly back from Hawaii to wherever you're going to be performing your audits, and you've got to test whatever the client was left out. So something in the audit was not properly tested, it was not disclosed. You have responsibility as an auditor to make sure that everything is okay. And if it is, okay, then you don't have to change your opinion. You just have to issue a revision saying we did subsequent testing of this because it was not a part of the initial audit. Everything was fine. You should know that this was not part of the original opinion. It's not a part of the original report. Here's where the problem comes in. What if the entity refuses to make revisions, take revisions? So you say, all right, I need to audit that warehouse of inventory. I've got to make sure that it's properly stated and we've got correct evaluation of inventory in the financials. It says, you know, we'd rather not do that because we're really happy with the unqualified opinion you issued. And we're afraid that if you audited this warehouse that you probably would not issue an unqualified opinion. So we're going to pass. We're just going to take your audit report as it is. What happens in that situation? Well, the very first thing you do is you basically say, look, here's the deal. If we don't get to test that inventory, if we don't get to test that item, you can't use our opinion. You can't use our report because the report was based on information that was incomplete. And we're making an assessment on information that we thought was complete. So you can't use that report anymore. We're going to rescind it. All right. And then if that's the case, you're going to contact any regulatory agencies having jurisdiction over the entity that the auditor's report can no longer be relied upon. If it's a public company audit, we're likely contacting the SEC and we're saying, here's the deal. They're trying to issue a report that's no longer valid because they didn't tell us about this warehouse full of inventory. All right. Then notify each person the auditor is going to be notify the auditor relying on the financial statements. For a private company, we probably have a list of major stakeholders that are going to be relying on this information, particularly if the financial statements are used for a specific purpose. If we're talking about general financial statements for a large public company, usually the regulatory agency is going to be the only practical way of issuing the appropriate disclosure. So we tell the SEC, they tell everybody who's going to be relying on that information. That basically does it. So we are done with chapter 17. Enjoy your extended break, and we will back on a week from now for chapter 18.